Bismillahir Rahmanir Rahim. Alhamdulillahi Rabbil Alameen. Wa salatu wa salam ala Rasulil Ameen wa ala alihi wa sahbihi ajma'in. Assalamu alaikum and a very good evening to everyone. I will be focusing on the prospect of risk-sharing instruments, given that we're talking about participating in a risk-sharing enterprise. I would like to specifically focus on the sukuk market and see what is the current prospect for a sukuk that is based on risk-sharing. If you look at the evolution of the sukuk market since the year 2002, when the sovereign government of Malaysia issued the sovereign sukuk, we have seen a variety of issuers tapping the market. We had sovereigns, we had corporates, we have supras tapping the market. We have a variety of instruments from senior unsecured sukuk using ijara concept to tier 2 subordinated sukuk issued by a financial institution, to exchangeable sukuk issued by a sovereign wealth fund, to tier 1 perpetual sukuk, which gives effectively an equity treatment for a financial instrument. But what is really lacking is the growth of risk-sharing instruments. They are all risk transfer. What we mean by risk transfer is it effectively transfers the risk to the corporate, and the holder of the sukuk become basically an unsecured creditor in most instances and a secured creditor in some of the sukuks. Now, although the sukuk instruments have assets for the instruments, but they're not backed. They're not CMBS or RMBS, as someone rightly pointed out earlier. Now, if you wonder why we don't see signs of risk-sharing instruments emerging, to the extent I could say 98%. Last year we had almost $45 billion worth of new instruments issued in the market. If you look at why risk-sharing is not emerging, we have to look inwardly to ourselves. When we have our surplus savings, after we receive our salary, we spend it on our expenses, whatever we have as surplus, we hardly go to a bank or to a financial institution and say, excuse me, don't put this money in my current account or a savings account which is guaranteed by deposit insurance or the state through lender of last resort. Open for me a risk-sharing deposit. I have not seen many. There might be some, but a great majority of us want our savings to be guaranteed. So you transfer the risk to the banks. The banks then transfer the risk to the corporates. Right? Corporates don't want risk sharing. I will show you an example of a risk sharing instrument. If it takes 2 months to do a risk transfer instrument, it will take a year to do a risk sharing instrument, because you have to look at all the risks, you have to see how to mitigate the risk, you have to see how to price the risk, and see how you can attract different classes of investors to participate in the risk. And economists know the price of equity is a lot higher than the price of debt. There are many reasons. The reasons are beyond the scope of the discussion today, but you will find that for corporates, it is much easier to issue a risk transfer instrument. It is a lot cheaper to issue a risk transfer instrument, and therefore they say, I also want the tax incentive. If I issue a risk transfer instrument, I have some tax credits. So you find overall it is a lot more attractive. The system that we have inherited, which is an alien system to the Islamic finance, basically promotes risk transfer instruments, starting from the individual level all the way to the sovereign. However, we are seeing some semblance of risk-sharing instruments in the market. And the two types I have seen emerging in Malaysia is, one is project finance sukuk, where the risks inherent in the project, it could be a power project, it could be a mass rapid transport project. The variety of risks are managed in a limited recourse or non-recourse financing. And we are also seeing the emergence of hybrid perpetual tier 1 sukuk, which effectively gives the sukuk the same status as an equity. Now, if you look at a typical project finance sukuk, it will involve, this is a transaction that was done in Malaysia. It was an $860 million sukuk issuance. There was an underlying asset. The assets basically back the sukuk. The recourse is to the assets only and to the cash flow generated by the assets. And you find that the sponsor, Kimanis, basically, effectively entered into an istisna, a construction, you can say it's an EPC contract, to develop the asset, and the sukuk issuer basically sold the sukuk to create the cash flow, and then passed it on to the EPC contractor to develop the asset, and the asset is then leased back to the project company to basically generate the revenue that will then pay the sukuk holders the profit, and the sukuk will be bought over time, so you'll get back your principal investment. So this has created a structure where the project company will be able to share the risks inherent in the transaction. I think they have put in the earlier version. This is the first version we sent. In a way, the project finance sukuk involves, at the early stage, construction risk. If there's a construction failure, the sukuk holders will not be able to get the principal amount or the returns they were expecting because the project has failed. So you have to provide the mitigants to avoid the construction risk. Then you have the supplier risk. Somebody has to provide you the feedstock to run the asset. Then you have the offtake. Somebody has to buy the asset that you are creating. It could be a power, it could be water, it could be the train service. So there must be an offtake arrangement. There's also the rates expectation. What if there's an increase in the interest rates or increase in the currency exchange rates? All these risks will have to be analyzed and mitigated in order to make sure that the project is viable. So it takes a lot of effort to create a risk-sharing instrument, to the extent that most corporates, because they have a huge demand for unsecured instruments in the market, prefer to go through the risk transfer instrument because it's a lot easier to do, it's cheaper, and there is a lot of appetite in both the conventional and the Islamic market. So you find that whilst we are seeing, in Malaysia, we have seen this 860 million sukuk issuance. Previously, a few months earlier, we had done another transaction. It was 3.29 billion for, again, a power plant. And the tenor was up to 20 years. So we had tranched the sukuk so that every time there is a built-up of the cash flow, we basically redeem the sukuk so that the sukuk holders can then have some investors may want a shorter tenor, 5 years. We see some of the pension funds and the takaful operators want a longer tenor, so we give them 20 years. So the risk and reward matches with the tenor profile of the investors. We've also seen, although project finance has been very popular in Malaysia, we saw one project finance sukuk being issued out of Saudi Arabia. This is $3.7 billion sukuk issuance for Saudi Aramco and Total JV. It was up to 14 years. Again, the sukuk holders' recourse was to the assets backing the sukuk and the cash flow generated by the assets. So whilst we are seeing these type of sukuks coming to the market, but the great majority are still risk transfer assets, instruments. And we are recently seeing banks coming to the market with what we call the Tier 1 perpetual sukuk. This is a sukuk where the funds will be invested in the Islamic bank's assets, and the tenor of the sukuk is perpetual. It's typically perpetual per non-call 6 years, for example. That means before the end of 6 years, the bank that has basically issued the sukuk cannot buy back the sukuk. After 6 years, they have an option to buy at the prevailing rate. And every year, from the revenue generated by the pool of assets where the investment has gone, a certain percentage of the asset is given as return to the sukuk holders. If there is no return generated by the asset, there is no coupon or no periodic distribution paid to the sukuk holders. And effectively, if there is a loss, the loss absorption is either in the form of you get your bond or sukuk converted into equity, or it's written off entirely. So the accounting treatment of a perpetual Tier 1 sukuk is equal to an equity. So we have seen Abu Dhabi Islamic Bank successfully issuing $1 billion Tier 1 perp sukuk. The total order book for the sukuk was about 15 billion. So there is appetite for risk sharing, except that it takes a lot of effort to bring the instrument in the market, and often corporates, like the depositors today, who don't want to share the risk, often take the easy route and go for risk transfer instrument. And similarly, Dubai Islamic Bank subsequently issued a $1 billion perpetual sukuk. Again, the subscription was $14 billion in total. So we do find there is some scope for profit and loss sharing based sukuk, But overall, great majority of the issuers tend to take the easy route and issue a risk transfer instrument, and we see this trend continuing in the near future. Thank you.